Welcome to the inaugural SORA Economic Forum. 2020 was a difficult year for humanity, and 2021 looks to be even more so. The world is going through a period of transition, and as in all times of change, we are faced with many difficulties. To solve many of the problems that we face as a species, we must cooperate and work together. We need to freely share knowledge and collaborate to rethink societies and how they should be structured in an era of increasing access to knowledge and the empowerment of individuals. SORA is about creating a supranational economic system that can efficiently provide capital to producers, thus pushing humanity forward, as well as a supranational and democratic governance structure to allocate capital in a fair way. Using technologies like blockchain, we aim to help humanity solve many of the current organizational inefficiencies in society. Towards this end, the SORA Economic Forum aims to be a venue for sharing exciting advances in our understanding of economics and governance. The month of June has always been an important month for SORA. It was in June 2016 that I first went to Aizu with Professor Tanaka from the University of Tokyo and met Professor Fujii from Aizu University. It was in Aizu that I proposed a regional blockchain-based currency for their city that included a reputation system to reward users based on their contributions to society. Unfortunately, regulation in Japan regarding cryptocurrencies changed quickly and the system was never able to be realized. But we did implement a limited version of this, called Byakko, at the University of Aizu as a campus digital currency. That went live last year. It was later in June of 2017 that I went to Awajishima and met with Professor Yamaguchi. It was Yamaguchi's son, Yohei Yamaguchi, who helped us significantly with our economic model and first proposed that we use a token bonding curve to manage the SORA token supply while the economy is still in its nascency. Indeed, it is the innovative use of the token bonding curve to provide a market-based approach to manage the circulating supply of SORA that really is the key to creating liquid value that producers can use as capital to power the creation of new goods and services. We hope that in the future, we can return to our roots and host this conference as a real, non-virtual event in Awajishima. Unfortunately, because of restrictions placed on travel by the world governments, we must content ourselves to host this event online for now. Today, we are blessed with many excellent speakers. Professor Richard Werner, whose study of the Japanese post-war economic system inspired my own interest in economics. In addition to being a rigorous scientist who pushed our understanding of macroeconomics further, he's also a wonderful human being who cares deeply about solving many of the problems faced by humanity. I had the pleasure of also taking his course at Oxford in the past, along with many central bankers. Another one of today's speakers, Nikita Gurin, who is from Google, was also at the same course at Oxford, and we share a common interest in both cryptocurrencies and cryptoeconomic systems. Turiel Berishis is a truly fascinating individual who has both practical and theoretical political experience. His publications about sortition-based, multi-body democratic systems have provided the core to the proposal I put forth last year for the SORA Parliament. There are still many practical and operational issues to solve, but the fundamental principles of his design hint at a much more fair and efficient way that social structures could be created. We are joined by many other amazing speakers, such as Tim Swanson, who I first met in 2015 when he worked at R3, Stefan Angelek, who works at Raiffeisen Bank International, doing some truly fascinating work with blockchain and who's also a huge fan of SORA, Traven Keith from Immunify, who I've known since 2017 and who has crossed crypto paths with me many times, Hen Tekel, one of the sharpest minds in the cryptocurrency and investment space, who thinks critically about long-term economic trends, and Gabriel Bed, who worked on the world's first blockchain-based central bank digital currency and who is the current ambassador to the United Arab Emirates from Barbados. It's quite an eclectic group of individuals who are speaking today, but the most eclectic are you, the viewers. Today's event will finish with a networking session where you can randomly meet each other and talk for 3 minutes at a time. This is a great chance to get to know other people with common interests and hopefully to build some relationships that can help create a diverse and energetic SORA ecosystem that can succeed in creating a new world economic order. for everyone who doesn't know me, I'm Makoto Takemiya. I'm the CEO of Soramitsu, and we're one of the contributors to SORA. So let me go through some of this. So this is me. I don't look Japanese, but I'm a naturalized Japanese citizen. And I'm the co-founder and the group CEO of Soramitsu. And we're a large for the blockchain space, crypto and blockchain company, focusing mainly on enterprise side of blockchain use cases, but we're also doing quite a lot in the kind of open blockchain or cryptocurrency space as well. I'm a computer scientist by training, and as a former research engineer at ATR, which is a research lab in Kyoto, Japan. So just a couple of things about my company. So we do quite a lot of work in the blockchain space. We've been around for 5 years, and we created a blockchain platform called Hyperledger Iroha. And we use Iroha for many enterprise use cases, one of which is the Bakong Central Bank Digital Currency Project in Cambodia. So that's just one of many use cases we've done. So one thing I wanted to point out is that we've worked on SORA since 2017, and we've worked in the Polkadot ecosystem with Web3 since 2018 on a project called Kagome, which is a C++ version of Polkadot. We've also done a lot of other things in the Polkadot ecosystem, for example, working on Fearless Wallet, which is really awesome, mobile wallet for Polkadot and Kusama, and of course PolkaSwap, which is a decentralized exchange on the SORA network. So today I'm going to talk a little bit about the SORA decentralized economic system and some of the theory and practice that we're trying to do. So when people think of blockchain and different things like that, they think of kind of like Bitcoin or some kind of crypto token, but these are just tokens that happen to be on a blockchain. They don't really have a full economic system around it. And what I mean by that is there's no rational mechanism for the allocation of capital in this ecosystem. So Bitcoin has an inflationary model up to 21 million or so, and then over time it will deflate. And all the newly minted Bitcoins go to the miners, so they don't actually go to people who want to build things in the ecosystem. And that's a problem. So you have to have a rational monetary policy, which is a way to allocate capital to producers. And many cryptocurrency projects just ignore this, and they don't have any rational monetary policy. And not having a monetary policy really is the same thing as actually having a very bad monetary policy. So not having any mechanism that's really understanding this and specifically trying to create a mechanism for allocating the capital in an economy is a problem. So can we apply our knowledge, especially from working with central banks, to do better? And I already talked about what I think an economic system is, as opposed to just a currency. An economic system is, of course, is built around a currency, or in the case of blockchain, cryptoeconomic system, around a cryptocurrency. But you also have to have a way to allocate these tokens, and you have to have a way to control the quantity in circulation. And why do quantities matter? So hopefully we'll get Richard on. Maybe he's joining already. No, not yet. But hopefully we'll get Richard on, and we'll be able to get him to talk about this in more detail. But for now, I'll just say that the theory behind this is really his disaggregated quantity theory of money. And in his work, he empirically showed that markets do not clear. They're not rational, and they're not in equilibrium. And so they're always rationed by some quantity. And so an example would be a credit market. There's an infinite demand for credit. Everyone wants money, right? There's an infinite demand for money, but there's not an infinite amount of money. And so that gives rationing to the credit markets. And really that allows the price is really determined by this amount of credit, not by the demand, because there's an infinite demand. That's just one simple example, but I think it's a very intuitive argument. And a lot of this is based on Fisher's equation of exchange, which is very simple. Or simply put, that the amount of money in circulation in an economy has to match with the amount of goods and services that you can use that money in. And when you just look at it that way, without considering different types or uses of money, there are many problems, for example, velocity decline, that become apparent. But it's Richard Werner's work that really showed that if you disaggregate the types of money used, you can solve a lot of these problems, and you don't have them. So that's his quantity theory of disaggregated credit. And he wrote about it very beautifully in his book, New Paradigm in Macroeconomics. So hopefully we'll get him on today, and he can talk about that. But yeah, we're trying to solve some of the technical problems there. But simply put, the disaggregating of the money really is splitting the types of money up into really two categories: money for real economic activity or for produce, and the other for financial activity or speculation or asset purchases. Right? So only the money for the real economy contributes to GDP, and for the financial economy, you don't have any new goods or services, so there's no new output, and so it doesn't it's a different type of money creation. So when you create money, when you're trying to help economic growth, you have to actually create new money for real economic activity. And so it's very simple. If you look at the equation of exchange, if you have more goods and services, you need more money to cover that. But also it works the other way, that if you want to create more goods and services, you can create more money for the goods and services. Small, medium enterprises will create these new goods and services, and then the money will be used in those transactions. In the financial economy, for asset transactions or speculation, if you create new money and purchase an asset, let's say like some stock or house that exists already. So if you purchase some existing asset, the asset price goes up because you're creating more money, you have more money in circulation, but you have the same amount of goods and services, so of course prices are going to go up. So that's very, very simple. I think that's extremely easy to understand. And really, this slide from Werner summarizes it very well, that when you're creating new money or credit in the traditional markets, you have really three different ways that you can create the money. One way would be for consumption. So minting new money and giving it out to people, like helicopter money, so they can go buy TVs. Right? That's one use case. Another would be to mint new money and then buy some houses or buy some Apple shares. So like the Swiss National Bank does this. They're one of the largest shareholders of Apple. So they create new Swiss francs and then they buy Apple shares. So Apple price goes up, right? And then, but these transactions don't contribute to GDP because you don't have any new output, right? So if you want to have economic growth, you have to create new money and you have to use it to create new goods and services as well. So the new money has to balance out with the goods and services. It has to be in equilibrium. Otherwise, you do get either inflation of asset prices, which is a bubble. That's not sustainable, or you get just consumer price index inflation where the cost of living goes up. And really, it's this case 3, the investment credit, that is really extremely key. So for example, why is this important? So recently, for example, El Salvador is accepting Bitcoin as legal tender in their country, and that's great. But Bitcoin is to them it's a foreign currency because they can't mint new Bitcoins. So they're at the mercy of this kind of external system. So what that means is for economic growth to happen, they have to get foreigners to come in and bring in their money and build new things, and then you get more money and more output. But typically when that happens, it actually hurts the long-term economic viability of a country. And this was shown in another paper by Professor Berner that showed that foreign direct investment is actually negatively correlated with economic growth, because foreigners, when they go to your country and they buy something, it actually, they have another agenda. They're not trying to help your country, right? So that's a problem. And so we'll see how it works out with Bitcoin in El Salvador, but it's really without a way to mint new Bitcoins to create new goods and services, they won't have any GDP growth. It's very simple. So how do you solve this? How do you actually make a better system? So that's what we're trying to do with SORA. We're trying to go from this theory into actual economic practice. And we're trying to focus on allowing countries like, for example, El Salvador to use a currency like ZOR, but at the same time, they can have it minted and given to SMEs in their country to create new output through a decentralized and democratic governance system. So the key missing component in cryptocurrencies like Bitcoin, I would say, is a decentralized economic allocation system that has some kind of democratic governance. So that's what we're doing in SORA. It's very simple, but it's not just enough to mint new tokens and give them out. You have to have you have to kind of bootstrap the value creation process, and you do this by being able to manage the volatility of the currency. And if it's too volatile, then people won't accept it. This is kind of old data on these charts here, but you can see that. As the Bitcoin in the previous bubble in 2017, the price went up a lot, and then when the price went up, merchant adoption also went up, but then when it went down, merchant adoption also went down, and so this was a very big problem. So you need to have some economic incentive mechanism designed for price stability and some kind of predictability or perceived certainty for the markets. So if you want stores to accept your cryptocurrency, you have to have some kind of predictability for them. You also want to have some kind of autonomous or circular economy, and this bootstraps the kind of the medium of exchange property of money. And so you need a mechanism that will allow producers to be able to get in and out of the currency in an easy way with some guaranteed liquidity. Otherwise, they can't rely on it as a medium of exchange. So in SORA, we're trying to actually solve all these problems using, the problems of kind of predictability or forward guidance and medium of exchange predictability, I would say liquidity guarantees, using a token bonding curve. And a token bonding curve is really simply put it's really a smart contract that holds some reserves of other tokens, and in exchange for inputting reserves, it mints a token, like for example ZOR. And if you want to kind of break out these reserves or take them out, you have to put in the token, and then that destroys it. So it's a way to kind of elastically create and burn tokens so that you have like a market-based approach that handles your quantity of token circulation. So this is very important in order to have some volatility dampening. Otherwise, it's not really useful in a real-world context. There's quite a lot of I would say nuances in the design, but really simply put, the token bonding curve in SORA has two different functions. There's a buy price function and a sell price function. And the buy price function is the price that people can buy at. And the sell price function is the price that they can sell at. And there's a 20% margin between the two. And we do that because we actually do quite a lot of work. We try to make use of this margin by expanding the ecosystem. So I'll talk about this in a few slides, but there's a good rationale to have kind of this margin between the buy and the sell. And there's many nice properties of this token bonding curve. So you can have guaranteed and immediate liquidity is one of the really nice properties, because as long as you have reserves, you can always, you have a guaranteed amount that you can exchange the token for. And this is extremely important when trying to, this is really important when trying to build a network of users of the token. The token bonding curve also does some volatility dampening in the upward and downward direction. So the buy price function really is, in many ways, kind of the maximum ceiling in the ecosystem for the price of SOR. And the sell price function, if the token bonding curve is fully collateralized, is the minimum price. So the way it works really is if the price of SOR is between these two functions, and if it goes up too high, then new tokens will be kind of minted and put into circulation. And then when the price goes too low, the reserves will be used to buy back and contract the SOR token supply. So it's an elastic supply mechanism where the token expands if there's lots of demand for it, and it contracts if there's not much demand for this. And we'll actually look at some of the numbers and current results in a little bit. Now, for those who are in the ecosystem, you may have noticed that we don't have full reserves in the token bonding curve. This is unfortunate, but there is some intrinsic demand for SOR, so this is eventually going to reach equilibrium. When there's not full reserves in the token bonding curve, the way it works is, instead of having this sell price function being kind of a straight line, what you have instead is it's a curve that kind of goes down over time. It treats it kind of like an XYK type of model, where you kind of pretend there's equal amounts of SOR in the token bonding curve already, and it calculates like a regular automated market making trade, like you would have on PokerSwap. So the cool thing is there is a mechanism for providing incentives for building up the reserves, and this is really the PokerSwap token, the PSwap token. The more tokens, when there's not much reserves in the token bonding curve, the rewards are very high, and when the reserves are more collateralized, the rewards go down. So it's kind of like this curve that you can see on the screen. At launch, there's 350,000 SOR. There's less SOR now because of burning, and I'll explain the numbers and some of the dynamics that are going on there in a few minutes. Maybe skip some of these more boring slides. So one of the other nice properties of using the token bonding curve is it gives you good observability of the SOR token supply and kind of predictability of it. And you'll see this in some of the numbers that I show you of the SOR token supply. You can actually predict that the supply is going to go down or go up depending on the price dynamics in the ecosystem. So it's really quite interesting. When the SOR price is going up, the token supply also is going up, and when the SOR price is going down, the token supply also goes down. So it's kind of a counter-cyclical quantity management, which is quite interesting. I think it's really quite fascinating. There's also other really nice things about this. One is that you're no longer limited by secondary market liquidity. The token bonding curve acts as a primary market, or it's an issuer of the SOR token. So what this means is that you can actually you're not limited by anything really. If you had $1 trillion, you could dump it into the token bonding curve, and it would happily give you a result. And it's quite interesting, because then countries could actually come in and use SOR without having to worry about being limited by liquidity, or companies like, for example, Tesla keeps talking about Bitcoin liquidity, and buying 100 million Bitcoins gives like a 2% price increase or something like that, $100 million in Bitcoin, like different things like that. But really, for SOR, it's really predictable. We have a flat function that for every 1,337 ZOR minted, the price goes up by $1. The initial price point is Musashi. It's $638, $634. Sorry, and then it goes up with the ZOR supply. So it's quite predictable. Because the token bonding curve also keeps the reserves locked up in this contract, the tokens that go into it are kind of essentially taken out of circulation. So the reserve currencies kind of are sucked in, and it gets bigger and bigger and bigger as the economy grows. And that's kind of the theory. Is eventually, you could wrap up the whole world economy in here, and eventually the ZOR token price would also grow linearly. The rationale of using the token bonding curve is not that you can't just mint money. You can actually. Countries do this all the time. And according to Richard Werner's research, if you create new credit or new money for productive economic output, so if you create new fiat currency via a form of bank credit, you give it to a company. The company creates new products that didn't exist before. That's actually good, and you can do that forever, actually, because human ingenuity is not really bounded; it's boundless. But in a cryptoeconomic system that's really young and nascent, you can't freely do that because you have to bootstrap the value of the token, and so that's what the token bonding curve gives us. It gives us a way to provide a predictable value basis for the ZOR token when the token is really in its infancy. Eventually, though, when you get into a larger global scale economy that's kind of circular and self-sustainable, you don't need to use the token bonding curve. You can actually shut it off even and just mint tokens through a democratic referendum. Let me check how my time is doing. Okay. One thing I really want to kind of focus on before I get into the governance aspects of SORA is the elasticity of the supply that the token bonding curve gives us. And for this, I'm going to show you some graphs I made. Okay, so this is some Python code that I wrote, but what you see in this figure is the ZOR token supply over time, starting at the first block, or block 0, and going up to the current block, which is like 700,000 something, or around 700,000. You can see on the so on the y-axis, you have the ZOR token supply starting at 350,000. That's when we did the network launch on April 27th. And then it immediately shoots up to, by about 3,000, so maybe 353,000 tokens. And then it goes kind of up, and then comes down and goes up, and then comes down, and then starts to kind of go down over time. And currently there's about 347,000 something ZOR in existence. So this really shows the token bonding curve in action. So you're injecting new ZOR into the economy, and you're also taking it out when the market goes down. This big Burj Khalifa style drop here is in mid-May when the crypto markets went down suddenly. So in basically a couple days, the token supply contracted by about 4,000 ZOR, which is more than 1% of the total token supply, which is quite big actually. And from that peak at like 360 something thousand ZOR, we've come down about 8,000 ZOR. So that's maybe like 2.5% of the token supply has been burned in the last month, really. So it's quite interesting. And in fact, more of the token supply would have been burned if there had been sufficient reserves in the token bonding curve. So let's take a deep dive into this and look at how this relates to the reserves. So this is the token bonding curve reserves of ETH. You can see that at the peak, there were around 450,000 30 maybe ETH in the token bonding curve, which is not nearly enough for collateralizing the SORA ecosystem, but it's not insubstantial either, right? So you can see that when the network launched, lots of people put in ETH into the token bonding curve, but the SORA price was too low at that time, and so it was immediately taken out because, yeah, that's how it works. You burn SORA, you take out reserves. And then you can see it was kind of flat at around 0, and then it, boom, shot up because the token bonding curve price kicked in, and eventually, lots of reserves were built up. And then you had like this initial price going down too low below the token bonding curve level, and then the reserves kind of cut off, and then it went back up, and then kind of dropped off, and it's been off for about a month. So that's one of the reserve currencies. So the other reserve currencies in the token bonding curve, for those who don't know, so the token bonding curve reserves we use now are ETH, DAI, VAL, and PSWAP. So for DAI, you can see the same type of Burj Khalifa type of style here, except here it's more in the middle. So at network launch, people were mainly putting in ETH, which is interesting. Maybe that means that more Ethereum users were coming at launch. And then you can see that suddenly it shot up to maybe more than $5 million or 5 million DAI in reserves. And then when the market crashed, everything just kind of like was taken out pretty fast. So if the reserves had been allowed to build up higher, then the SORA token price probably would have stabilized more when the market was going down, because all the tokens sold into the token bonding curve are burned. You can see also for VAL, there's quite a lot of purchases at the beginning, and for PSWAP at the beginning, but we don't see large amounts of sustained reserves of VAL and PSWAP. That's because there's special bonuses for buying from the token bonding curve with ETH and DAI, but not with VAL and PSWAP. So it seems that the market is kind of rational. There, you do see a little bit of a peak in the middle here when the price went up, because actually buying from the token bonding curve is cheaper than buying from the secondary market. That's why you actually got some reserves built up. There's different statistics that we could talk about here. But one thing I wanted to also show is the community made this really great tool, PokeView.io/PokeSwap, and you can see here, you can actually watch the SORA token supply if you select ZOR and maybe select something. So this is like maybe like last 24 hours. It's interesting. So in the last 24 hours, like 0.1% of the ZOR token supply was burned, which is quite interesting. Maybe you can look at last week. You can see that in the last week, the SORA token supply went down almost 0.3%. So if you extrapolate this over a year, it's like more than 15% of the SORA token supply would be burned at the current pace, which is quite substantial, I think. So the SORA token supply now is around 347,800 something, and which is down quite a lot from the initial supply of 350,000. So it's quite interesting to kind of see how this is trending towards an equilibrium where eventually the enough ZOR tokens will be burned where the intrinsic demand will actually reach the quantity, and eventually the price will stabilize at the token bonding curve rate, which is quite interesting. Anyway, that's kind of the basic points about the economic system. I should probably talk a little bit about governance, but I also wanted to point out that we do a lot of system dynamics modeling. So we kind of sat down last year, and we, before any of this was built, we actually went and modeled a lot of it using this really cool toolkit from Python BPTK, and we were able to find different causal loops in the ecosystem that kind of should have very nice dynamics. So actually, every transaction burns some vals or in PSwap, and so this is a very nice dynamic because you have some intrinsic demand built into the system itself. So in overview, the whole Sora ecosystem really is that you have this token bonding curve at the center. That's the primary market for ZOR, and then this is burning and minting ZOR, putting it out into market. But you also have the citizens, the Sora Parliament, and these are users who have at least 150 ZOR will be able to register as a citizen, and then they'll be randomly chosen to make decisions. There's going to be an investment fund that's set up that is going to invest in different companies for equity, and then the citizens will be able to make a yes or no decision on this, just to make sure there's no misappropriation of funds. But the actual proposals of investment should be done by professionals. So you can see that companies will take investment from the Sora investment fund, build new goods and services, and then accept the ZOR as in exchange for their goods and services. This builds up you have more M in circulation, but you also have more goods and services, PY, more output at some price level, and then this will expand the Sora economy, completely separate and in addition to speculative activities that people are doing. So, from a technological standpoint, we have the Sora network. It's running on parity substrate. We're working towards getting a parachain slot, hopefully this year. And we also have a bridge to Ethereum, and we'll build bridges to other EVM-based chains shortly. This is a big, decentralized open ecosystem. So we hope that anyone can help contribute new pieces to it and help us build this greater vision. But the vision really is to become a parachain, and then to have things like price oracles, synthetic assets, maybe even a rebasing EVM bridge to other chains. So we hope to make it really vibrant and interesting. We're also working on improving the front-end user interface and user experience, and we want to show things like statistics about the token bonding curve, reserves, and price level. So that's some of the overview of the Sora economic system. But what about the governance? So the governance is, like I pointed out at the beginning, is really one of the key parts of any kind of economic system. And so we base a lot of our work on the democratic principles from Athens. And Athenian democracy, many people have a really weird view of Athenian democracy as being some popularity contest, similar to like American style democracy today. But in reality, it wasn't like that. So Athenian democracy actually evolved quite a lot over a period of more than 200 years, and it relied heavily on randomly choosing decision makers to make decisions. So the three key principles of the Athenian democracy were political equality, called in Greek isonomia, the right to speak and contribute, isegoria, and then sortition, which is randomly choosing different participants to get a wide variety and diversity of different political views. So these this specific model will be talked about more tonight by Tyrell Bericius, who's a political scientist and also former politician in Vermont. And he'll be talking about this in more detail. But we kind of were heavily inspired by his model, and especially his paper, Democracy Through Multi-Body Sortition, Athenian Lessons for the Modern Day, in the Journal of Public Deliberation. And he recommends having multiple bodies, each having their own clear boundaries, so that you don't have the same people proposing and the same people making the decisions. And then, of course, you need different ways to have like a spam filter and make sure there's time is not being wasted and different things like that. So what you have is different committees. You have a rules committee that it kind of sets the overall rules of the system, and this committee is randomly chosen from the citizens. So Let's say if it's like 30 people for 3 months, these 30 people would be randomly selected and then would partake in this committee for 3 months. But they're not allowed to actually change all the rules. They propose rules that are then voted on by other committees, like the policy jury. You have the Agenda Council, which takes a proposal from a citizen. Any citizen can make a proposal, and then the Agenda Committee will look at it and say, is this a waste of time? Is it spam? It's a spam filter, basically. So it will look to see if it's a topic that makes sense, and if it does, then they set the current agenda of deliberation to this proposal. Once they do that, you have interest panels that will then take, these are just people who raise their hand and say, hey, I have an interest in this topic, let me speak about it, or let me write a report about it. So there's no limit to the number of different interest panels. So anyone who's interested in it can participate. This is the Greek principle of, that anyone who wants to contribute can contribute. So if it's an interesting topic, people will come and write a study about it. And actually to have a professional, a consistently high level of quality, we want to make it so that there's actually like a full-time staff or potentially ministries that will also supplement just random volunteers, so that there are experts or panels of experts that are kind of already determined for different domains. I think that that will make the ecosystem much more reliable. So the interest panels write reports, and then they give them to a review panel. The review panel will collate the different reports from the interest panels, and they will kind of propose like a consistent format listing pros and cons that's unbiased. Remember that the review panel is randomly chosen by Sortition, so hopefully you would get a good distribution of views. Then they give this to the policy jury. The policy jury is a randomly chosen body of citizens that actually make the decisions. They actually vote yes or no on a proposal. So they get the proposal report from the review panel, they read the pros and cons, and then they vote. In addition to this model, we also have different committees. We have a monetary policy committee that would be in charge of monitoring the economy and different statistics and writing proposals. They're not allowed to make all the decisions themselves, but instead they write proposals that are then voted on by the policy jury. And then you have the Financial Markets Authority, which is kind of like the regulator. For example, like PokerSwap is a DEX. It might be useful to have some different rules. Who can list tokens? Like, what are the rules around that? Like, how do you get whitelisted? A Financial Markets Authority that's decentralized and chosen from random citizens can help create these rules. Again, they can't create all the rules themselves. They just make a proposal that's then voted on. And then you have an oversight council that actually watches everyone and makes sure the process is being followed correctly. So that's kind of like the governance that we have in SORA. So how does this fit into a greater picture? So most cryptocurrency projects have, a lot of vagueness. So a lot of them have like a governance system that's based on token voting. They have maybe, some different mechanics around the token supply, like maybe miners get, some tokens in some vesting curve. But really, you don't have clear distinctions between all the different layers and the different pieces. And but nation states have these. So an example would be, like a traditional nation state, has the different layers of the governance, the financial markets infrastructure, the debt money, capital markets, different things like that. So in SORA, we actually try to have kind of a clear and comprehensive economic system where there's a governance layer at the bottom that's democratic based. So you don't have, you don't want people obviously to allocate money for themselves. So having a democratic and popular oversight helps prevent that. And also through collaborating and bringing in many different perspectives, people can, hopefully you'd get higher quality. And then you've got the ZOR, val p-swap tokens. You've got the token bonding curve that's really kind of implementing monetary policy, and the reserves of the token bonding curve are providing for the price stability and kind of a foreign exchange stability of the tokens. And then you've got the SORA Parliament's investment fund, which would be investing in the producers and SMEs who are actually building things and having real economic output. So that's kind of building a very comprehensive and hopefully sustainable ecosystem that can work into the future. So we've done quite a lot over the past year in implementing this. We went from the initial proposal of the new economic order last July, and then we actually, to help the community, we went and built it all. There's several referendums. The community voted on changing the tokenomics, on releasing the system, and all these things. Now we also have a decentralized network that's running with more than 100 validators around the world. Many people, many volunteers working together and helping to build this new and really vibrant ecosystem. So that's all I have to say today. Well, there is one more thing. So one last thing I'll just say is that we've been doing a lot of research on synthetic assets, and there's going to be some really exciting things coming in the next few weeks, I would say. So XST is a synthetics platform that I first proposed in 2018, I think. 2019. I first proposed in 2018, but I wrote a paper about it in 2019 and spoke at a conference in Seoul about it. Really, the idea is to kind of take Irving Fisher's ideas about stabilizing a gold-backed dollar from the 1910s and then building this into a cryptoeconomic system now. So what does this mean? The idea really is very simple. You have a volatile token like ZOR that you can mint and demint using a smart contract, and you have a stable coin that's backed or pegged to DAI, let's say. This would be XST DAI or XST USD. And what you would do is, if you want $100 worth of this XST USD token, you take your $100 worth of ZOR and you put it in the smart contract, it burns the ZOR, and then you mint you this new token. And this token is valued because you can put it back in the smart contract and it will mint you new ZOR and then give you the ZOR. So even no matter what the price of ZOR is, it will always mint enough ZOR to cover the contract. And so this really becomes like a stable coin that's a synthetic asset. It's just pegged to some index. And the cool thing is you're not limited by liquidity anymore. So you have infinite liquidity. So if you want to go from ZOR to XSTUSD, you could dump the whole token supply into this instantly and you would have no price impact because it's a synthetic asset. And the opposite is also true. So to me, that's really exciting. This is work that's in progress and hopefully coming to a testnet soon. So that's all I have to say. I'll take some questions now. So let me stop sharing my screen. And let's see what kinds of questions people have in the chat. Somebody wrote that the SORA system is quite complex for ordinary citizens to grasp at first. How would you ensure that citizens who hold 150 ZOR are factually able to contribute to decision making? I would say this is really where the 150 ZOR is really a spam filter. It's a way to kind of prevent just random people from coming in. And also to prevent Sybil attacks because it costs, there's non-zero costs, so you can't just for free create a bunch of accounts. So that's what the 150 ZOR does. Now, once you're past that, the multi-body pipeline of the proposals really is what is the key to success. So the fact that you have interest panels that can be made up of professionals is really a key towards high-quality decision-making. So even if you're not an expert, let's say in nuclear energy, if you read a report that's written by experts in a clear and simple way with pros and cons, even normal people should be able to make a decision. So, and if they can't make a decision, then it's a failure of the experts to communicate well. And that's something that can be fixed through education. Somebody asked if I could share my Python notebook. Yeah, I'll share the notebook, and I have some code that also at each block prints out the reserves. So this data can be useful for people. I'll put that on GitHub later. So somebody said, yeah, the current number of ZOR is too big, like given the TBC reserves. This is true. It's true, but there is quite a lot of ZOR that's already locked up. So for example, I think like around 15% of token supply is locked up in validators. And then, like around half of token supply is locked up in liquidity pools in PokerSwap. So there's quite a lot of use and demand for ZOR already. So I'm not really too worried about I'm not too worried about the quantity of ZOR right now. I think that it will, life will find a way. If the price goes too low, it'll just burn faster. So I'm okay with it. I think it'll reach equilibrium. Somebody asked, do I envision that ZOR will someday be allowed to exist and be accepted as a currency by the central banks of the world? That's a very good question. I think that countries like El Salvador could make use of ZOR much better than Bitcoin because of the stability mechanisms and the elasticity of supply that's market-based, and the governance structure. So the way this fits into El Salvador is that instead of having an external currency like Bitcoin that you can't control, you would actually have you'd actually have the ability to participate in the democratic process. So the government of El Salvador could say, hey, we want $1 billion worth of ZOR to build a new hydroelectric dam or something. And then they could propose this to the community, and then people can study it, see what the benefit would be to the ecosystem. And if the benefit is large, they should be able to, to get the capital allocated from the community. So that's really how different governments can participate in the existing ecosystem. So central banks could do the same. They could participate in the SORA parliament, and they could make proposals, and then they could be part of the professional team that is actually trying to manage the monetary policy. Do I expect to have discussions with certain countries? Well, yeah, we already do actually about using ZOR. So, but these things take time. Maybe at a future SORA economic forum, we can make some announcements, but not today, unfortunately. But it takes time. So lots of people are complaining about like the ecosystem being so complex. Well, I mean, it's really not that bad. I think it's much simpler than existing financial markets infrastructure that you see in the existing economy, and so I think people will get used to it. So anyway, that's all I've got in my time slot allocated for. So we're going to take a quick intermission and then go on to our next speaker, which is Stefan Angelik from Raiffeisen Bank International.